Hi, everyone. Welcome back to Reverend Consulting's educational video series where we interview industry experts to help you find the right structure for your funds and successfully raise capital. Today, I'm joined by Andrew Doup, founder of Syndication Counsel. Syndication Counsel focuses exclusively on advising clients on how to organize and invest through private equity, venture capital, and real estate syndications. Andrew advises clients on how to organize private funds and partnership with federal and state securities regulators, as each private fund, as you know, varies in terms of how they raise money, how they deploy the capital into investments, and how they pay their returns. We'll be discussing these points in today's video, so let's get started. Andrew, thank you so much for joining us today. Welcome. And so tell us about your professional background, how you got started and what really made you kind of focus on private equity and working with real estate sponsors.
Angela, first of all, thank you for having me. Really happy to be here and happy to share what I know with you and your audience. My name is Andrew Doup. I founded a law firm called Syndication Counsel. We help entrepreneurs navigate compliance with securities laws to raise investor capital with confidence. 85% of the US population, my household growing up, did not participate in private markets and alternative investments because we didn't satisfy the criteria that the SEC requires, which is investors must be accredited. This was a whole new world to me. Didn't actually even learn about it until law school. Became really interested in this marketplace that actually exceeds the size of the public markets. Really just dove into it. I became fascinated with how entrepreneurs who may not have the equity they need to capitalize their business plan, they've got the sweat equity, they've got the drive, they've got the vision, they've got the business plan. They just need to find the right investment partners to make their business idea a reality. I love taking individual parts and turning them into a partnership to create an outcome greater than the sum of its individual parts and making change. I've also come to really enjoy working with entrepreneurs as well. So I mentioned, started my study of this market, the laws and regulations that govern it in law school. Ended up working with a corporate law firm as my first job and joined their securities practice group. And that's where I cut my teeth. More recently decided I really just wanted to better focus on this. Rather than having my attention split in 1,000 different directions, I knew that this was a work that I enjoyed. I really believed in the impact that entrepreneurs were making in this space. And that is the reason why I decided it was time for me to start my own boutique law firm to better focus on this area of law.
That's great. And you work with like private funds, like venture capital and real estate fund managers. And what would you say are some of the things that I guess first-time fund managers, let's just maybe, talk about like real estate fund managers. What do you think are some of the things that they may get wrong and right when they first decide to structure their funds?
Maybe I'll begin answering that question by first describing the type of clients that I'm working with in this space, because you mentioned a couple of them. Yes, there are fund managers. There were also company founders. I mentioned entrepreneurs as kind of a catch-all category, but also real estate developers and even private investors. When I'm meeting with one of these entrepreneurs, irrespective of what background or class they come from, when I'm meeting with them, what I'm spending my time doing is learning more about what it is they want to do. Because in some cases, you have an entrepreneur who wants to start a private fund and they want to raise a round of investor equity so that they can then go invest into operating companies that are managed and operated by a company founder. Or they want to invest into a real estate development project in their community. Or they wanted to invest into a friend's portfolio of single family homes. So there can really be a wide range of industries and asset classes. The common denominator is you have someone who is sponsoring the formation of the real estate syndication or the private fund. And they're doing that because they want to pool investor equity to then go provide an economy of scale for an operator. So whether you call that a syndication or a private fund, the most common mistake that I see up front is not having that clear pathway for what it is they're trying to achieve. I think it's easy for someone to want to raise a fund and manage a bunch of money, but unless they have a business plan or they have a thesis that they are actually planning to invest into, then they've got a lot of thrust, but not a lot of vector. Part of what I do is provide some guidance on the direction that any individual client wants to go.
What would you say is kind of like the typical range of capital they're looking to raise? For entrepreneurs, is it more in like the like a million to five or 5 to 10? What are the ranges that you see? I know you work with a variety of clients. I'm just kind of curious to see how and what they're like how much they're looking to raise depending on the scale of the projects and their objectives.
So I work with clients that have raised anywhere between 6 figures to 10 figures. So a very wide range. Sometimes our discussion involves accurately scoping the amount that they really need to raise in order to execute on the business plan that they have. So I'll give you an example. I may be working with an entrepreneur who, maybe they want to raise a round of private equity to begin investing into real estate. They want to raise a $100 million fund so that they can pick and choose which real estate projects to invest into. One of the challenges of just taking that blank check approach, it's not going to resonate with the investors that you want to raise money from. They want more specific plans. They want to know, what is it that you're going to do with my check when I hand it to you? Do you have a portfolio or a pipeline of assets, of target acquisitions that you've identified, whether it's an operating company or whether it's a real estate project, or do you not? And if the answer is yes, then tell me more about what those underlying assets are. And then based on how that discussion goes, maybe I'll agree to write you a 6-figure check until you get that first one done, and then another 6-figure check for the second asset. I guess what I'm saying is this kind of relates back to your first question about most common mistakes that I see for folks that are getting started in this space. It really doesn't matter how much you want to raise. What really matters is, what are you going to do with it? And ultimately, that's going to be what resonates with the investors that you're speaking with.
And that's what you advise your clients on, right? If they come to you with just not having specific ideas about what types of projects they want to invest in and things like that. So you help advise the clients on getting to that point.
Yeah, that's right. Yeah, that is, that's part of the service that I provide. There are also oftentimes situations where a client, they do know, what asset they want to invest into, having already defined what their business plan is and what it is they want to invest into, and in exchange for what return and for what rights, what ownership rights for that matter, might guide the discussion to, well, how much do you think you need, or how much do you want, and how much do you really need? Because if you're organizing a real estate syndication, probably not going to want to raise more than the developer needs in order to close on a construction loan, for example. You don't want to over raise. Of course, you want to raise enough to cover the cost of your investment and also any organizational and offering expenses such as legal, accounting, marketing, etc. The conversation's a little bit different if you're organizing a private fund. Say you don't know exactly what asset you're investing into now, although you do have investment thesis and you may have an initial target acquisition. There are some reasons why you might target a maximum raise, but be satisfied with making your first closing well before that max raise so that you can begin deploying the LP equity that you do bring in sooner.
Oh, and and you will have to excuse my ignorance on this, but when it comes to syndications, is there a capital raise amount that's like is there like a maximum where they can't raise more than that? And what about the timeline? I'm just kind of curious to see if there's like a limit to the amount they can raise and what the timeline looks like.
There are really two ways to approach that question. I'm gonna approach it with the regulatory answer first, because of course, when we're talking about raising capital, that activity is highly regulated by the federal government agency called the Securities and Exchange Commission, but also by state securities regulators as well. And so there are laws and there are regulations that govern how much you can raise and from the types of investors you can raise that money from. What I can tell you is generally the majority of private capital that is raised under just one exemption, and it's referred to as Regulation D. That's an exempt securities offering safe harbor under the Securities Act of 1933. And the reason why the majority of private capital is raised under that exemption is because there is no limit from a regulatory perspective on how much you can raise. The more practical answer is, how much do you need to raise in order to achieve your investment objective? That's the more practical answer. And again, that can depend on your investment thesis. There were a bunch of other exemptions under federal and state securities laws that have more concrete ceilings on the amount you can raise and who you can raise it from. But generally, the majority of private capital is raised under a rule where there is no regulatory cap. Really the limitation is more practical. It's how much can you put to productive use? Second part of your question was, how much time can you raise for? And the answer, again, is partly driven by regulation, but also partly driven just by practical consideration. Under the rules and regulations, again, there are many different exemptions that offer different rules. And part of what Securities Counsel can do for entrepreneurs is help find the most suitable pathway for regulatory compliance just based on what that individual entrepreneur's goals and objectives are. From my perspective, my general advice to clients is you don't want to raise equity for more than 1 year. And the reason why is just from a practical standpoint. Once you approach the 12th anniversary of when you closed on your first investor, you may begin to run into valuation issues between your first investor and investor X, who's writing you their check on month 12. There may be an inherent conflict of interest between those two investors. If investor X is buying in at the same price as patient zero or investor one, how is that really fair to investor one? Because they believed in you earlier and they wrote you the check earlier. So how is that fair to the early investor? There are different mechanisms that you can put into place to kind of ensure equity and fairness among investors or limited partners who enter your fund at different points in time. But generally where we see that conflict arise is at that 12-month timeline.
Oh, that's really interesting. Do you see any, I guess, common concerns or some questions that seem to come up often from like first time, syndicators?
Yes. So I'm an attorney, Securities Counsel. A big part of what I do is help entrepreneurs navigate compliance with these complex federal state securities laws. But my worst case scenario, one where an investor or where a client has invested a bunch of money into legal compliance, but they're unable to close on an investor check, right? Like that's kind of the worst case scenario for me, because I know that in any securities counsel would be able to help a client navigate the complexity of securities laws with confidence. But the next question is, well, will your offering sell? Is there a market for what it is you're selling? And if the answer is no, that's a huge problem because you've invested a lot of money into your offering and organizational expenses, and then your investment thesis ends up failing. First-time fund sponsors or real estate syndication sponsors, if you need a little bit, if you want to test the market for the terms that you're offering, then what I often advise clients to do, if they're not yet ready to make that substantial upfront investment into those offering and organizational expenses, instead, just start with a term sheet. Start with a one or two page term sheet that outlines your investment thesis, what it is you want to do, how much money you need to raise to do it, and what you're expecting your investors will receive in exchange for their investment. If you've got that term sheet and it's confidential and it's non-binding and you're taking it to your pre-existing network of substantive relationships, that's a regulatory term, then you can have discussions with a potential lead investor about whether or not your terms are acceptable. And if they are, well, guess what? You've got the confidence you need to make the investment in the offering and organizational expenses. And by the way, you've also secured your first lead investor.
Oh, that's a really great idea. I didn't even think about that. Okay. Do you think that oftentimes they underestimate how difficult it may be to raise capital? Like, I'm just kind of curious because just from a marketing perspective, I think that a lot of fund managers, I do see the sponsors, they do really focus on structuring the fund the right way, which is extremely important and making sure that they understand the capital raising goal and all that. And the last thing they think about is the actual marketing of it, I would say, or getting investors. I'm just kind of curious to see how they can get ahead on that. And you mentioned taking a term sheet to the close family and their own personal network. Is there something else that they should be thinking about as they're just like structuring their syndication or anything else?
Yeah, I would say if you go the term sheet approach and you do secure verbal commitment or, a head nod from a prospective lead investor, you're going to also want to include mentioning this phrase offering and organizational expenses, includes legal setup, accounting setup. You also want to include a marketing budget. To your point, Angela, in my experience, marketing private placements has been an opportunity that has been incredibly underutilized. And the reason why is because until 2013, it was actually illegal to market and advertise a private placement. So the law changed to enable marketing and advertising of these private funds and real estate syndications. But the majority of the industry has been extremely reluctant to take advantage of that change in the law. Well, why is that? Many different theories out there. In my opinion, the rules are clear on what you need to do in order to market and advertise. It's just a matter of putting systems and processes in place to ensure compliance with those rules. I think there's another explanation, and it's that people who were successful in raising investor equity before this rule change, they don't need to market and advertise. They've already got the pre-existing network of prospective investors. Where I see the opportunity for new fund managers and for new and emerging real estate syndicators is cast a wider net, extend beyond your network of friends and family, put together a marketing campaign, take advantage of this generational change in the law and use it to your advantage. We opened our discussion with a statement about how I knew nothing about private markets until I went to law school. Well, according to the SEC, only 15% of US households can even participate in private markets because only 15% of the US population satisfies this regulatory criteria to participate as what's called an accredited investor. What does that mean for you as a fund sponsor or a real estate syndicator? It means that you need to market. You need to find this narrow class of investor, cast the widest net that you can, get together with a marketing professional who has specific experience in exempt securities offerings and formulate a plan because the money's out there and oftentimes investors are looking for alternatives to Wall Street. They would much rather invest into their local community, for example. They would much rather invest into Main Street than Wall Street. And it's just a matter of finding a sponsor that can offer that opportunity to them.
Yeah, and that's a really interesting point because I think that the number of accredited investors is growing almost every year. And we keep hearing about this great wealth transfer that's taking place. I think that's currently taking place. And I just saw something this morning about how the millennials and Gen Z, Gen X, they're set to get this trillions of dollars from their parents and so forth. And the way that they will be making a decision about investing in private funds will be very, very different. So that's a really interesting point. And you mentioned the fund structure. So until 2013, I assume a lot of the firms were structured as 506B, right? 506C is what allows them to market themselves. Do you see that fund structure becoming more popular? Are first-time sponsors going into that route because they want to have the opportunity to do that? Like what's kind of like the common fund structure that you're seeing right now?
I wouldn't say that I could see 506C becoming more popular. I mean, just the amount of private capital that's raised under 506B, it greatly exceeds the amount of money that's raised even in the public markets. Where I see the difference between 506B and 506C is 506C, I think, is going to resonate better with millennials, with our generation, because this is the exemption that enables people to market and advertise online to people that they don't already have a pre-existing substantive relationship with. And what we're seeing is that it is an incredibly successful tool at achieving the regulatory intent behind the exemption. What is the regulatory intent? Well, I mentioned the regulator here is the Securities and Exchange Commission, the SEC. Their mission is to promote capital formation and protect investors from fraud. 506C goes a long way in promoting capital formation, specifically for entrepreneurs who need to cast a wider net than their pre-existing network of prospective investors.
Excellent. Are there any other things that you would like first-time sponsors to know about? And also, how can they reach you?
So, I obviously spent a lot of time in the world of private securities offerings. And because of that, the internet has an algorithm profile of me and what my interests are. And so on a daily basis, I'm receiving headline news about how entrepreneurs are being charged by a state or federal securities regulator for fraud. And you mentioned that's the second part of the SEC's mission, is protecting investors from fraud. All right, so if you look past the headline and actually dive into the complaint or the case, then you can see that in a lot of these cases, these charges are about issues that could have easily been identified and managed. If you're a first-time capital raiser, whether you're organizing a private fund or a real estate syndication, then I would urge you to seek the guidance of securities counsel so they can help you identify those issues and help you navigate them so you can ultimately do what you want to do and pursue your business goals in compliance with federal and state securities laws and regulations. So I'm happy to chat, Angela, further with you and anyone, in your audience. Best way to find me is online, syndicationcounsel.com. You can also find me on LinkedIn, Andrew Doup.
And I'll be sure to include a link to your website as well as a LinkedIn profile. And also, you have to get Andrew's newsletters because they're amazing. You send out these really great emails with some latest updates and things like that. And as a marketer, I really appreciate all the insights that you share. So I hope that whoever's watching this checks that out. And yeah, I think with that wraps up our discussion. And thank you so much, Andrew. We really appreciate your time, and we would love to have you back for another great video. And thanks again for sharing your insights with us.
Thanks for having me, Angela.